Well, welcome everybody. We have another great program with a fantastic guest that is very relevant to what's going on today. And what we have is Denise, who is the CEO of the Appleby Retirement Consulting, Inc., a firm that provides IRA tools and resources for financial, tax, and legal professionals. She has over 20 years of experience in retirement plan field, which includes providing training and technical consultation to financial, tax, and legal professionals. And, Denise, we know that, there's been a lot of changes this year. We had the Secure Act pass at year end, and we had a whole bunch of things that affected a lot of our listeners with the COVID-19 issues. And so I thought we'd have you on because a lot of these impact people that have retirement accounts. And so I just want to, first of all, welcome you and thank you for taking the time to educate our listeners.
Thanks for having me on. As you know, I'm a consumer advocate when it comes to retirement accounts, and I get so many questions from professionals. But as you and I agreed, sometimes we want to cut out the middleman and break it down for the consumer so that they're armed with the knowledge that they need to go back to their financial, tax, and legal professionals.
And as you know, the listeners here are getting this program through their insurance or financial professionals. And the theme to all these programs, you want to be educated, but you also want to work with your professionals. Don't try this alone, because the mistakes that you make can be some real landmines for people. So let's start out, Denise, with the CARES Act. How does that affect the required minimum distributions?
Yeah, well, I think everyone now is aware of the pandemic resulting from the coronavirus disease, COVID-19, which includes people not being able to go to work, people not being able to go to school, people's income being reduced. Pretty much we're locked away and we have no money coming in, or we have reduced money coming in. That's the case for a lot of people. And so the CARES Act was signed into law on March 27, 2020, to provide relief for businesses and individuals from a financial perspective. And included in the CARES Act were two key retirement provisions. One, for people who are supposed to take required minimum distributions. They were waived for 2020, and I'll talk about what a required minimum distribution is in a second. And two, the rules that would usually prevent you or dissuade you from taking distributions from your retirement accounts have been relaxed. So now it's easier for you to take money from your IRA without worrying about certain things. I'll talk about that in a minute too. And then you have more time to roll it over. So let me first go back to required minimum distribution, because that is a very hot topic right now. And the question is, what is a required minimum distribution and who's supposed to take it? If you were at least age 70 and a half on December 31st, 2019, you were supposed to take a required minimum distribution this year. The IRS provides a formula that the financial advisor or financial institution or 401k trustee uses to determine how much an individual is supposed to take as a required minimum distribution. Now, here's what happened. Your required minimum distribution is sort of a percentage of your account balance. But remember, because of the pandemic, the market, let me just say tank, that's not a right technical term, but you know what I mean. The market went down in about January. And so now people are looking at their retirement savings account thinking, hang on a second, if I take my required minimum distribution, that represents a much bigger percentage of my retirement account that I'm used to. I don't want to do that. And so part of the CARES Act, the relief provided under the CARES Act, was to say to individuals, listen, because of what went on with the market, we're going to waive required minimum distributions for 2020. So as long as you have a required minimum distribution from a 401k type plan, 403b, IRAs, or even if you're a beneficiary, because some cases when you inherit retirement accounts, you're supposed to take required minimum distributions too. Those are waived for 2020. Now, there's one exception though. If you're receiving required minimum distribution from a defined benefit pension plan, those are not waived. And that's mostly because you don't have to worry about market performance with that. Your employer handles that. But for the accounts that are defined contribution plans, IRAs, there's no required minimum distribution for Roth IRA owners, but they do apply to Roth IRA beneficiaries. So talk to your advisor. If you took an RMD for this year and you want to put it back, talk to your advisor about what the rules are as far as putting those amounts back in your retirement account if you want to.
Yeah, Denise, that's a great point. I can't emphasize enough. I mean, we're in a complex world that just became a much more complex world with all these changes that have happened. Some of them, we kind of knew were coming for a while, and that had to do with the required minimum distributions being extended to 72. That's something that happened, that's been talked about over the last couple of years. Accelerating the money coming out to beneficiaries of IRAs that are not a spouse. We kind of knew that was in the pipeline, so it wasn't a big surprise. What was a big surprise to everybody was this COVID, where all of a sudden we had a change in rules right in the middle of the year. So you were talking about required minimum distributions and how it's waived for this year, but what about all the clients that took the money out in the beginning of the year? Do they have any options to replace that or somehow change that, or are they kind of locked in?
It depends. If you take what would have been a required minimum distribution had it not been for the CARES Act, you can put it back as a rollover contribution. But there are certain limitations. For instance, if you took the required minimum distribution from a beneficiary account, you couldn't put it back. An exception applied to required minimum distributions from beneficiary IRAs that permits a non-spouse beneficiary to put it back as long as it was rolled over by August 31st, 2020. Now, if you're a spouse beneficiary, you don't have that limitation. You can still use what is referred to as the 60-day rollover rule to put it back. So generally speaking, you took what would have been your RMD, you want to put it back, you have 60 days to do that. There's one other limitation that have prevented some people from putting back required minimum distributions, and that limitation applies to individuals who took multiple distributions from a traditional IRA. Now, some people set up their IRAs that way. The idea is, I want X amount every month to cover my expenses. So someone who got a distribution in January and February from a traditional IRA would be able to roll over only one of those distributions if it being rolled back to a traditional IRA. So I know a lot of people are thinking, oops, I took two of those distributions and I did roll over both of them. What's the problem now? Well, if those rollovers were completed by August 31st, 2020, and were rolled over to the same IRA from which the distributions were made, then you're fine. Outside of that, if they were rolled over to a traditional IRA after August 31st or to a different traditional IRA, then you want to talk to your professional and see how you go about making corrections.
Well, I'll tell you, Denise, I'm pretty up on this, and I followed you. But I'll tell you what, it was hard for me to follow you, and I know this stuff. I can't imagine someone listening to all that and then fixing their problem on their own. It sounds like there's a lot of trap doors that if you aren't right on top of every part of that rule, you could end up making a pretty big mistake, right?
You could end up making a pretty big mistake. For instance, let's say you took two distributions from your traditional IRA and you rolled over, meaning you put it back to traditional IRAs. You put back both of those distributions. If that rollover was not completed by December 31st, or I should say, if those rollovers were not completed by August 31st to the same IRAs from which the distributions were made, then only one of those amounts could have technically been rolled over, which means the second one creates an excess contribution in your account. And now you're going to have to talk to your professional to say, do I have a problem here? And if so, how do I go about fixing this?
Well, that I really appreciate you sharing that, because that you went over every detail and it is complex. And then I can even throw in, something that became a permanent part of the law is required minimum distributions going directly to charity tax-free. Now, the fact that people don't have to take RMDs, they can still do their RMDs to charity if they wanted to do that. Is that correct?
Yeah, a big misconception is that the qualified charitable distribution provision is tied to a required minimum distribution, and it's not. So here's how the qualified charitable distribution provision works. If you are at least age 70 and a half on the day that the amount is distributed from your IRA, and that amount is paid to an eligible charity, then that distribution is completely tax-free. Now, remember I said if you're at least age 70 and a half, right? And remember, under the old rules, your RMDs were required to begin for the year in which you reach age 70 and a half. So a lot of people sort of tied them together. And when the rules that you referred to earlier, when the Secure Act extended the age at which you're supposed to start RMDs to age 72, the question for many people were, does this affect my qualified charitable distribution? And the answer is no. You don't have to be subject to an RMD in order to do a QCD. So you can still do your qualified charitable distribution, even though you don't have a required minimum distribution this year.
And I'll tell you what, I just learned something there, because I was under the misconception that was tied together. And then the other trap that I've seen people get into, under the old rules, it was you had to take the money out by, April 1st of the year following that you turned 70 and a half for that year. And sometimes, you could take your RMD, at age 70 in the year you took the year you turned 70 and a half, you could actually take your RMD beforehand, but giving the money to charity, you had to wait till you were 70 and a half. Am I correct on that?
You're absolutely correct. And that's an excellent point, because I know there are people who are going to be listening to this next year too, right? And so they're going to have that question. How does this affect my RMD? And here's how it ties in. You can do a qualified charitable distribution or QCD as long as you're at least age 70 and a half. But the question becomes, if you're supposed to take an RMD for that year, do you want your QCD to go towards satisfying your RMD? Because that can be done. Your QCD can serve double duty. It can be done as a charitable donation, and it can cover your RMD. And if that's what you want, then the QCD should be the first distribution that is made from your IRA. Why? Because for any year that you're supposed to take an RMD, which is going to resume in 2021 unless things change. So come 2021, if you want your QCD to serve as your RMD, you got to make sure that the QCD is the first distribution that is made from your retirement account up to your RMD amount. Good point.
And that's, one thing I want to make sure, giving to charity is a powerful thing. And I don't want people to listen to this and think, oh man, this is just so confusing, I'm not even going to bother looking at it. Because it is a significant thing. You're really able to double dip on deductions. Because normally your charitable contributions, make up part of your itemized deductions. And right now with the high standard deduction, especially for people in retirement, a lot of people don't get any deductions with the charitable contributions that they make. Well, if you're able to take out money out of an IRA, a traditional IRA tax-free, and give it to charity, and you're going to give to charity anyway, it's like getting a deduction for that amount, and it doesn't affect your standard deduction, so you get both. So it's a powerful planning tool, and a lot of people that don't need the money from their IRAs, if they're not taking it out and have a plan for how to pay the taxes, they're just building up a huge potential tax liability for themselves in the future or their heirs when they inherit it. So here's a way to get money out tax-free and do things you might already be doing, like giving money to your church or other favorite charity or synagogue, whatever it might be. It's a great planning tool that you want to talk to your professionals about. Now, we're going to take a short break, and Denise, when we come back, we haven't really scratched the surface yet on the COVID-19 special provisions as they relate to retirement accounts. So we're going to cover that when we come back. Please stay tuned.
Having a conversation with your child is like putting money in the bank. For example, every time you ask your child,
"So, how was your day?"
you've just added to your conversation trust account. And when you say to your child,
"Good job, son,"
you get double deposits. And the more you ask, the more you put away. And it's good advice to... excuse me. And it's good advice to have... Stop that. And it's good advice to have little chats with your child as often as you can. Thank you. Because someday, when they're teenagers, it may pay off big dividends.
Dad, can I ask you something?
Give your family everything. Give them your time.
Thanks, Dad. I think you're right.
Welcome back as we continue to visit with Denise, who is the CEO of Appleby Retirement Consulting, a firm that provides tools and resources for financial, tax, and legal professionals. And before the break, Denise, we were covering the complexities of the RMDs and charitable RMDs. And again, RMDs are required minimum distributions on retirement accounts. All retirement accounts will have required minimum distributions at some point. Many people are aware of Roth IRAs, and there's no required minimum distributions for the account holders, but even those have required minimum distributions when they pass to non-spousal beneficiaries, which is a fancy way of saying, for most folks, kids and grandkids. So, Denise, let's talk a little bit about, there's been a lot of talk about how you're able to get money out of IRAs and other retirement accounts like 401ks, where you could do that in the form of a loan or a premature distribution without penalties. There's a lot of misconceptions out there and misunderstandings. So could you walk through how those work, what it takes to qualify, what happens if your 401k provider doesn't want to deal with the record keeping of this and all those kind of issues? Talk about that. I know this is going to take a while to answer.
Definitely. So these are called coronavirus-related distributions, right? And those provision, or the provision for a coronavirus-related distribution was included under the CARES Act to allow individuals to take money from their retirement account because they're first facing dire financial circumstances, right? So let's talk about what is a coronavirus-related distribution. It's a distribution that is made by a qualified individual from January 1st through to December 30th. It's capped at $100,000, and it can be taken from any type of retirement account. Now, part of what you alluded to was the fact that an employer is not required to permit a coronavirus-related distribution from, say, a 401k type plan. So if you're listening right now and you're thinking, hey, I was laid off, or my spouse was laid off, or someone in my home is facing financial difficulties as a result of COVID-19, whether they lost a job or they were offered a job that was deferred because of COVID-19. So generally speaking, most people are going to be eligible for this, right? So now you're at the point where you're thinking, yeah, I meet that eligibility requirement. How do I get that money from a retirement account? Let's look at the accounts by account type. For IRAs, you usually control when you take money from your IRA. So you can just go to your professional and say, I meet the requirements for a coronavirus related distribution. I want to take 100,000 or up to 100,000. And you as the individual are responsible for making sure that you don't exceed that $100,000 for coronavirus related distribution purposes. Now, they're going to send you the money for $100,000. If you're under age 59 and a half, you won't pay a 10% early distribution penalty. Now, when it comes to a 401k or 403b type plan, it's different because it's up to the employer to determine whether or not they want to offer that provision, because even though the law says it's available, they don't have to. And some employers are choosing not to offer that provision because they just don't want to be bothered with the administration of it. And so the question for you becomes then, if your employer is offering coronavirus related distribution, then you can take it. But what if not? What if they don't? Then find out whether or not they offer any other type of distributions. For instance, it might be a distribution from an old employer's plan, or your current employer might allow you to take what is referred to as a hardship withdrawal. In those cases, you can take that distribution. And even though the employer is not treating it as a coronavirus related distribution on their end, you can do that when your tax return is filed. Now, here are the tax benefits which needs to be reflected on your tax return. The first one is if you're under age 59 and a half, there's no 10% early distribution penalty. That 10% distribution penalty usually applies to anyone who takes distributions before age 59 and a half. Now, some issuers, and by issuers, I mean IRA custodians, financial institutions, plan administrators, when they issue the 1099-R, which is the statement that is issued to show how much distributions you took from your retirement account, they're supposed to indicate on that 1099-R, to be quite specific, it's in box 7. They're supposed to indicate in box 7 that the distribution is exempted from the 10% early distribution penalty. But realistically speaking, because this is new, many of these institutions have not been able to change their systems to reflect the proper code to say the amount is exempted from the penalty, but that's okay. Don't be alarmed, because even if they indicate on that form that the 10% penalty apply, the IRS has provisions that the tax preparer can use to override that on your tax return. So that's the first tax benefit. The second tax benefit is the ability to spread income from that distribution over 3 years. So typically, when you take a distribution from your retirement account, say you take a distribution in 2020, if it's not a coronavirus related distribution, you have to include the entire amount on your 2020 tax return. That's the general rule. For coronavirus related distribution, there's an exception that permits you to spread that distribution over 3 years in equal amounts. So 2020, 2021, 2022. Now, if your tax advisor says, listen, I know spreading it over 3 years seems like a good deal, but based on my mathematics, it's better if you include it in income, all of it in 2020, that election can be made on the tax return. So there's some flexibility there.
So Denise, I got a couple questions as you're going through that. So one would be, I know with the normal 401k loan provisions, if you took a loan out that your provider, your 401k provider would allow you to take. So again, it's up to the plan documents whether some or all or none of these loans are available. But under the traditional loans, my understanding is you had to pay that back in 5 days. And if you separated from employment then all that had to come back at once, or it was considered a premature distribution. So how does that work if someone does one of these COVID-19 loans and it's out of their 401k and they get separated from service? How do you get that money back? Are you allowed to set up an IRA and pay it back? Or does that work like the other loans where it triggers an immediate distribution?
It depends. Is it okay if I quickly just finish wrapping up the coronavirus-related distribution? Because there's one benefit that I left off, and that's the ability to put the money back or roll it over 3 years after you receive it. So that's one final benefit. And let me now answer your loan questions, because in addition to the coronavirus-related distribution, the CARES Act allows eligible individuals to borrow 100% up to $100,000 from their 401k type accounts. And you're right, except in cases where the loan is taken for purchasing your primary residence, the loan has to be paid back in at least quarterly installments within a 5-year period. And so for many individuals, the question is, what if I leave my employer while I'm repaying that loan? What happens then? And what you're talking about is the fact that some employers will say, if you're leaving, then you have to repay the loan now. And if you don't, then it's treated as a deemed distribution, which becomes taxable to you and subject to the 10% early distribution penalty. Now, for an individual who's a qualified individual under the COVID-19 rules, there are some breaks that are offered for these loan provisions. You could get a 1-year extension for loan payments that were due from March 27, 2020 up to December 31st, 2020. So there's that. Interest continues to accrue on that loan. If you find that you leave your employer and you're required to repay that loan, try to see if you can prevent that loan from becoming a deemed distribution and instead have it be treated as an offset. Usually the loan is in good standing when it's treated as an offset. The difference is, for an offset, you can roll over the amount that represents the offset, usually by your tax filing due date plus extension. But the guidelines do provide an offset to be treated as a coronavirus-related distribution, which comes with the benefits that I just talked about that applies to a coronavirus-related distribution. So as you can see, there are many moving parts here that we need to pay attention to.
So a good thing to do is ask your team of professionals, your CPA, your financial professional, make sure they're on top of this before you act, because I'm a financial professional and this is confusing for me. And what I would have to do with each individual client is to make sure we work through each part of those details to make sure we're not tripping over something else or falling into a trap door, because this is very complex and confusing. Another thing I just want to point out, I hear a lot of people talk about, oh, we don't have a 10% penalty, we just have to pay the tax. Well, the thing is, if all this money is adding on top of your other income, let's say you're in a 12% bracket, and when you pull that money out, it pushes you into a 22% bracket. Well, that's the same as a 10% penalty because you're paying 10% more tax. So you need to do the math before you just start acting so that you know what the tax consequences are. You have a plan to pay it back if you can't afford to pay the taxes. You got to be serious about it, because you can find yourself in a world of hurt without a little bit of planning ahead of time. So are there any other things that people should be aware of here before December 31st that they might want to make sure they at least review, if not even act on?
Yeah, and I agree with you on the taking of the distribution, by the way. Just because you can doesn't mean that you should. You really want to discuss that with your professional. To answer your question about things that we need to be aware of before year end, yes. Part of what you talked about earlier was the changes that were made under the Secure Act. Now, if you remember, when the Secure Act was signed into law in December, there was much ado about the fact that what we refer to as the stretch was taken away from most beneficiaries. So now, unless you're a spouse, a beneficiary that's not more than 10 years younger than the account owner, or fall into some other narrowly defined categories, you have to distribute the account within a 10-year period. But if you inherited that account in 2019, then you're still under the old rules. And so if you did, you want to talk to your professionals about the steps that you need to take to make sure that you maintain eligibility for the rules that apply before the Secure Act went into effect. And this is especially important if you are one of multiple beneficiaries, and one of those beneficiaries is a non-person, such as a charity or an estate, because if you don't take certain action by September 30th, then the account is treated as if it doesn't really have a beneficiary, and you are required to take distributions under a much shorter period than if the charity, say for instance, takes a full distribution of the charity share by September 30th of this year. Also, certain trusts are eligible to be treated as individuals for stretch distribution purposes. Documentation relating to the trust must be provided to the custodian or plan trustee by October 31st of this year for accounts that were inherited in 2019. And finally, if you are one of multiple beneficiaries that are individuals, let's say one is 20 years old and one is 50 years old, the 20-year-old and the 50-year-old has to use the 50-year-old's age to calculate beneficiary distributions, which shortens the distribution period for the 20-year-old unless the account is split into separate accounts by December 31st of 2020. So when you talk to your professional, if you inherited an account in 2019, take a copy of the account statement to them and ask them whether or not there's anything you need to do to make sure that you receive the benefits that were in effect for beneficiaries before the Secure Act was signed into law.
And I would say before you have the professional doing that, I think a good question would be, are you familiar with this? Because just because someone's a CPA or an attorney or a financial professional doesn't mean that they're necessarily on top of this. So I would make sure that they're on top of it. If not, they're a great resource to do the research to get on top of it. And I just see so many people make mistakes when it comes to retirement accounts, inherited retirement accounts, where they just want to get things taken care of. They fill out the distribution form and they end up getting a lump sum. And once you do that, it's irrevocable. There's no fixing it. You're just stuck paying unbelievable amounts of unnecessary taxes. So with that, I want to finish up, Denise. I didn't cover your whole bio in the beginning, but you definitely have, I could have spent a half hour just talking about all your accomplishments. And I know that you have a master's degree in jurisprudence in employee benefits. You have several professional designations, but more importantly, you've created a lot of resources for professionals. And, I don't know if you have stuff for the consumers as well, but if someone wants to find out more about these subjects, what resources do you have available?
They can go to my online dictionary. The web address is retirementdictionary.com. It's a free resource. I try to break down the rules for consumers because, as is clear from our conversation, this is a very complex area. So I try to break it down into English for our consumers. And thank you for mentioning that. I really appreciate it.
All right. What was that website again?
Retirementdictionary.com.
Again, Denise, you're one of the most knowledgeable people I've ever talked to on retirement plans, and your breadth of knowledge across all the different aspects is amazing because it's very few people I come across. And there's a lot of people, that claim they're IRA experts or 401k experts, but when you really get into the nitty gritty, a lot of times they'll fall short. So I would encourage anybody with their professional, maybe check out her resources. And it wouldn't be a bad idea this year to do a review of where you're at, Make sure you're on top of all the things that are happening. This is a very unusual year, not just because of the COVID-19 from a personal standpoint, economic standpoint, but we got a whole bunch of different rules that people can take advantage of or be swallowed up by if they're not ahead of the curve and doing the proper planning. So Denise, thank you so much for joining us today.
My pleasure. Thank you.
The views expressed are not necessarily the opinion of the advisor or the broker-dealer and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Individual circumstances vary. Investing is subject to risks including loss of principal invested. No strategy can assure a profit against loss. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. The information discussed is educational in nature and is not and should not be construed to be tax or legal advice. Tax and/or legal advice is not offered by your financial professional. Please consult legal or tax professionals for specific information and additional guidance regarding tax-related matters as they pertain to your individual situation.
Thanks for joining us, and tune in again as we explore another phase of the real wealth process. And remember, if anything you heard in today's show you'd like to get more information about, contact your Real Wealth advisor. Also, if you feel that any of this information will be helpful to a friend or family member, just click the Forward to a Friend button.